Good afternoon, ladies and gentlemen. Um, the Monetary Policy Committee met on the 25th and the 26th of March 2019 against the backdrop of developments in the global and domestic economic environments in the first quarter of 2019. 11 members of the committee were present. The global economic developments. The committee noted with concern the weakening performance of global output growth at the end of 2018 and observed that developments in the first quarter of 2019 were characterized by legacy headwinds from the second half of 2018. These include the continued trade war between the United States and China, policy uncertainty amongst the advanced economy, central banks' persisting uncertainties surrounding Brexit negotiations, vulnerabilities in major financial markets, and rising public debt in some emerging markets and developing economies. Consequently, global output growth for 2019 was downgraded by the International Monetary Fund, IMF, from 3.7% to 3.5%. Price developments across advanced economies continue to moderate in the review period alongside signals of weakening output growth. In the light of this development, the US Fed, the Bank of England, and the European Central Bank retreated from their earlier stance of monetary policy normalization in favor of a monetary policy accommodation. This led to volatilities in the financial markets of the advanced economies as the balancing of portfolios moved capital from the equities to the bond markets. The MPC noted the moderate appreciation of the US dollar against currencies of most advanced and emerging market economies. It further noted the trend of declining long-term yields in the United States and the likelihood that capital flows may be redirected to emerging market and developing economies in the medium term. Domestic output developments. Output data from the National Bureau of Statistics, NBS, indicate that real gross domestic product GDP grew by 2.38% during the fourth quarter of 2018 from 1.81% and 2.11% in the previous quarter and corresponding period of 2017. The major impetus for growth came from the non-oil sector, which grew by 2.7% during the fourth quarter of 2018, while the oil sector contracted by 1.62%. Committee welcomed the continued positive sentiments in the manufacturing and non-manufacturing purchasing managers indices, PMI, for the 24th and the 23rd consecutive months in March 2019. The manufacturing PMI rose by 57.4 index points compared to 57.1 in the previous month. Similarly, the non-manufacturing PMI increased by 58.5 index points compared to 58.4 in February 2019. The increase in both measures of PMI were driven by increases in production, employment, raw material inventories, and new orders. This improved outlook was attributable to the continued stability in the foreign exchange market, various interventions by the bank in the real sector, and the effective implementation of the economic recovery and growth plan by the federal government. Furthermore, on the current measure of national output, the NPC noted the need to rebase the GDP, an exercise which was last carried out in 2010. Developments in the money and prices. The committee noted that broad money supply contracted by 1.98% in February 2019, below its level at December 2018. Net foreign assets contracted by 7.47% in February 2019, relative to its level at the end of December 2018. In contrast, M3 grew by 4.31% in February 2019, compared with its level at the end of December 2018. Net domestic credit also grew by 10.68% in February 2019, and the growth in NDC was accounted for by the increase in the credit to the government, which grew by 17.2% in February 2019 over its level as at December 2018. Credit to the private sector also rose by 6.41% compared with its growth benchmark of 9.41%. Given the positive trajectory, the committee urged the management of the bank to sustain the various initiatives of the bank, particularly the partnership with the Bankers Committee and the Nigerian Incentive-Based Risk Sharing System for Agricultural Lending (NIRSAL), aimed at establishing a national microfinance bank to cater for the micro, small and medium enterprises as well as the small and medium enterprise sectors of the Nigerian economy. The committee noted the continued moderation in inflation as headline inflation year on year declined further to 11.31% in February 2019 from 11.37% and 11.44% in January 2018 and December 2018 respectively. The decrease in the headline inflation was driven mainly by food inflation, which declined to 13.47% in February 2019 from 13.51% in January 2019, while core inflation declined marginally to 9.38% from 9.91% in the previous month. On a month-on-month basis, headline food and core inflation declined by 0.1 and 0.01 and 0.15 percentage points to 0.73, 0.82 and 0.65% in February 2019 respectively, from 0.74, 0.83 and 0.81% in January 2019. The committee noted the upside risks to inflation to increase, high cost of energy, infrastructure constraints, insecurity in some parts of the country, and anticipated increase in liquidity from the late implementation of the 2018 budget, and noted that most of these factors were outside the ambit of monetary policy. The MPC therefore urged the federal government to sustain its current efforts in stimulating output growth by executing the policies approved by the Economic Recovery and Growth Plan. The net liquidity position reflected the impact of open market operation auctions, foreign exchange interventions, statutory allocations to states and local governments, and maturing CBN bills. Consequently, average interbank core rate increased to 16.45% in February 2019 from 15.0% in January 2019. The open buyback OBB rate, however, declined marginally to 18.79% in February 2019 from 19.71% in January 2019. On March 22nd and the 8th, 2019, the OBB and interbank core rate, however, closed at 14.39 and 8.0% respectively within the monetary policy rate corridor. The committee noted that in spite of the recent upsurge in capital inflows into the economy, the oil share index and market capitalization continued to decline, reflecting global sentiments in portfolio rebalancing from the equities to the fixed income securities. These reflected generally perceived risks at the long-term end of the yield curve. The committee noted with satisfaction the continued stability in the foreign exchange market at the investors and exporters window of the market, and in particular it also observed the moderate improvement in oil prices and stable accretion to external reserves, which stood at 44.23 billion as at March 21, a 6.8% increase from 42.35 billion at the end of February 2019 and 6.38% growth at the end of January. The overall outlook and risks. The medium-term outlook for the global economy continues to be uncertain, with indications of increasing macroeconomic vulnerabilities and downward revision of the forecast for global output growth. On the domestic economy, available data on key macroeconomic indicators for output growth during the first quarter of 2019 and forecasts for the rest of the year suggest continued positive outcomes. Based on recent projections, the economy is expected to grow by 2%, that's the IMF, 2.2% by the World Bank, and 2.74% here at the CBN. The projection is hinged on the enhanced flow of credit to the real sector, sustenance of a stable exchange rate regime, moderating of inflation rate, the CBN special interventions in growth-enhancing sectors, especially agriculture and non-agricultural SMEs, improved growth in the non-oil sector, and the effective implementation of the ERGP by the federal government, among others. Committee expressed optimism that the establishment of the NIRSAL, National Microfinance Bank, and the enactment of the Secured Transactions in Movable Assets Act of 2017 will stimulate lending to small and medium enterprises. Staff forecasts indicate that inflation will commence a marginal upward trend from March 2019 through May 2019, when prices are expected to begin trending downwards. The committee acknowledged the headwinds to these forecasts to include low credit to the private sector, increasing external debt burden, volatility in the financial markets, fluctuating oil price, threats to capital inflows, and decline in external reserves, which could exert pressure on Naira exchange rate in the medium term. The committee's consideration. Committee observed the tepid output growth in 2018, but noted with satisfaction that it strengthened in the last quarter of 2018, as well as positive forecasts for 2019. It further noted with great satisfaction the continuing moderation in all measures of inflation, sustained stability in the exchange rate, and the robust level of external reserves. It commended the recent upsurge in capital inflows into the economy, noting this to be a demonstration of sustained confidence by foreign investor community in the Nigerian economy. The committee was, however, not unmindful of developments in the global economy, noting the recent slowdown in growth in some advanced economies and the dovish stance of some major central banks as an early warning signal of broader macroeconomic vulnerabilities. It therefore underscored the need to monitor the trend of capital flows and the continued downturn in the equities market, noting that the recent surge in portfolio inflows were concentrated in the money market. The committee noted the relative volatility in oil prices and its impact on accretion to reserves, which could easily undermine the stability observed in the foreign exchange market. It, however, noted that current developments in the oil futures market indicate that oil prices will remain considerably above the federal government's 2019 budget benchmarks. The committee therefore urged the federal government to strengthen the current revenue mobilization efforts as well as explore additional sources of revenue in order to improve fiscal buffers. It further urged the federal government to sustain its implementation of the ERGP while ensuring that growth is all-inclusive. It reiterated the need to concentrate efforts on addressing the problem of power infrastructure as well as support domestic manufacturing. The committee also called on all relevant institutions to address the menace of smuggling and dumping of goods into Nigeria and encourage the management of the bank to continue to explore available scenarios to deal with the activities of economic and policy saboteurs, including those involved in dumping and smuggling, in a bid to accelerate domestic production of goods in Nigeria. The MPC noted the positive moderate outlook for growth and the risks in the horizon. The committee also noted that, having achieved a relatively stable exchange rate with price stability, it is imperative that the monetary policy should explore the next steps necessary for enhancing growth, reducing unemployment, and diversifying the base of the Nigerian economy. It further observed that per capita income growth is very negligible, while aggregate demand remains weak. Aggregate output also remains below the potential output level, implying sufficient headroom for non-inflationary growth. The new direction has therefore become imperative against the backdrop of the aftermath of the general national elections and strong inflow of foreign direct and portfolio investments into the Nigerian economy. The committee urged for the speedy passage of the other aspects of the Petroleum Industry Bill to fast-track the development of the value chain in the sector and create employment. It also welcomes the passage of the National Minimum Wage Bill by the National Assembly and called for its speedy implementation in order to boost domestic aggregate demand. The committee also observed that the performance of the monetary aggregates were below their benchmarks, indicating headroom for monetary growth. The MPC also noted the encumbrances and constraints imposed on fiscal policy and the associated vulnerabilities, as it has consistently failed to mobilize sufficient revenues to support development as enunciated in the Economic Recovery and Growth Plan, leaving room for continued debt servicing not previously envisaged. Against this backdrop, it is imperative for monetary policy to provide the much needed leverage to support output growth and employment generation in the country. On a more cautious note, the committee expressed concern and sympathizes with the fiscal authorities over the growing fiscal deficit, external debt and debt services, as well as the need to closely monitor the public pronouncement process in order to improve efficiency in public resource management. On financial system stability, the MPC noted the improvements in key financial soundness indicators and commended the federal government for the settlement of debt owed to oil marketers, which has considerably helped in reducing the non-performing loans portfolio in the banking industry. The committee therefore urged the government to expedite action in addressing all outstanding contractor-related arrears so as to improve the NPL position and stabilize the banking system. In addition, the MPC reiterated the bank's commitment to improve credit delivery, especially to small and medium-scale enterprises, while acknowledging efforts by the Central Bank of Nigeria in coordinating the de-risking of lending to the private sector through collaboration between the Bankers Committee and the NIRSAL. In its consideration of the best monetary policy option, the committee noted the need for all agencies of government to work hard, not only in consolidating the growth so far achieved, but also in ensuring that appropriate policies are put in place and implemented to create jobs on a mass scale, as well as diversify the economy in the proper direction. In doing this, the policy options facing the MPC at this meeting is a decision between retention of the current stance of monetary policy or a slight loosening at the policy rate, backed by the substantial stability of the major macroeconomic indicators. The committee felt that given the relative stability in the key macroeconomic variables, there is a need to signal a new direction, and in which case we're talking about being pro-growth. In its argument, the committee was convinced that doing this would further uphold the bank's commitment to promoting strong growth by way of encouraging credit flow to the productive sectors of the economy. The MPC also felt that signaling through loosening by a marginal rate would serve to manage the sentiments in the capital flow market, owing to the wider spread in yields in the emerging market and developing economies relative to the advanced economies. Moreover, the real interest rates will still remain positive. Committee's decision. In light of the above, the MPC decided by a vote of 6 out of 11 members to reduce the monetary policy rate by 50 basis points, that is 0.5%. 2 members voted to reduce the monetary policy rate by 0.25%, 25 basis points, while 1 member voted to reduce it by 100 basis points, which is 1%. 2 members, however, voted to hold MPR at its current level. 10 members voted to hold all other parameters constant, while a member voted to reduce the cash reserve ratio by 100 basis points from 22.5 to 21.5. In summary, the MPC voted to 1. Adjust the MPR by 50 basis points from 14 to 13.5%. 2. Retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR. 3. Retain the CRR at 22.5%. And 4. Retain the liquidity ratio at 30%. I thank you all for listening.